Okay, so step two is one of these steps that you can do after any single journal entry. I mean, we could have started step two as soon as I made this very first entry here on 1/1, or you can wait until the end. Now, doing it one at a time might allow you to not miss any entries. Fair. It can also perhaps, I don't know, send you back to the ledger too many times. I know when I'm cooking, I like to cut everything, make the first cuts on everything, and then if it's a different sort of cut, I make the first cut, put them all to the side, and then I take them all and do the second cut. So really, it's dealer's choice, whichever seems to work better for you. Here, I did the entirety of step one and am now moving to step two. In real life, as you do step one, typically step two updates automatically, and the computer program you're working with saves it in. And you're saying, well, if I have a computer program in real life, then why the hell am I learning this way by hand? Because you learn to add before you got a calculator. You got to know what you're doing, how it enters the system, when something is done for you automatically, it's great as long as it's working. But then when someone questions your work or says, this came out wrong, why? You're like, well, I don't know. I just put stuff in. That's not a sufficient answer. So we need to understand how this is all working together and how the information is entering the accounting cycle in developing itself into something we can use to make financial statements. So this next is posting entries to the ledger. We're trying to make sense of all of this chaotic accounting. And we do so by now grouping everything into T accounts, right? The ledger is really just a formalized collection of T accounts in our system. The first account I'll work with is cash. It's also the busiest account by far. Now, whenever you make an account, first question needs to be, does it have a beginning balance? Right? Now, our cash account does. The beginning balance it has is the ending balance of the prior period, right? This is a full circle cycle. We keep moving around in the same circle. We finished on 12/31/X4. Now we're through the month of January. We want to do this whole cycle for the month of January. If this is the ending of 12/31/X4, it's also now the beginning of 11/X5. So that $35,000 is the start of our cash balance. Now, what I would do, given that we've already finished everything, is to go through and check off every account that I'm going to move into my ledger. So I started here, look for cash. Oops, here's a cash number. Let's put a little check by it to, you know, to assert that we're moving it over, which will be important as we make sure we've included everything. 30,000 credit. If I credited cash by 30,000, left is debit, right is credit, then I would put the 30,000 down here as a credit to the cash account. All right, look for the next instance of cash. We don't have to look far. $47,000 as a debit. That debit then goes here, right? Journal entries tell me what side, left or right, I put this on because debits increase the cash account, credits reduce the cash account. The next cash transaction was a credit of 24,000. So now I need to credit that account. Notice that I'm staggering, that I'm not putting 35 and 30 on the same line and 47 and 24 on the same line. This helps me when I'm checking my work. because then I can make sure that if there's a mistake somewhere, I transferred everything. It helps to have them separated so I can see which came first. What is the next cash number I need to see to check that I put it in correctly? There was a $250 cash credit on the 9th. The next one is a $32,000 cash debit on the 10th. A really complete ledger would have dates out to the side too. That way, it's even easier to tell if you got the right numbers, if you transferred everything over appropriately. The next cash piece that I see is a $48,000 credit there. And then a $47,000 debit when we sold that machine. A $24,000 debit when we received payment in advance for the the amounts we're going to earn later that we recorded as deferred revenue. $20,000 was credited to pay our suppliers. 10,000 was debited when we made our sales. And finally, now we're on the same page. I kept looking for the page. Let's see. Cash came in here on the 28th when we collected from our accounts receivables. And then we had another inflow of cash when we sold our stock. Right. We got cash is always going to be an active hopping account. So I have all of the entries I made listed out here. And after, let me just check my key to make sure that I absolutely brought everything over, that we don't have anything missing, because I don't want to lead you astray in a teaching example, always horrible, right? After that, we would add all this up, right? Add it all up, 35 plus 47, 32, 47, 24. So every debit is adding, every credit is subtracting, right? So we could even just do 35 minus 30 plus 47 minus 24 minus 250 plus, you get the idea, right? All of that math comes out to 122,750. Okay. This is if we have now included all of the cash transactions that we recorded in our journal entries. This would be our unadjusted cash trial balance, unadjusted trial balance amount. Right. So in step two, I'm sorry, butting up against the computer for page real estate here. In step two, what we're doing then is logging in all of those journal entry amounts into the account, reconciling them together to get 122,750. Now, notice I only draw this line when I want to reconcile everything. What does that mean? It means I want to take all these numbers and crunch them together to see where I'm at. In practice and in my teaching, these topics, I will typically only reconcile and draw a line when I'm coming up against a trial balance. So I want to know where I am for my unadjusted trial balance, which is step three. I draw the line, I reconcile all the numbers that have happened. I get the new balance for my unadjusted trial balance, right? Let's do one more account just to be sure. And then the rest, We'll leave them. I will show you the answers for sure. And then leave the rest for you to work on if you need to or don't need to. That's your pleasure. Um, so one account well, actually, let's do just a couple more. They won't be as long as the cash account, I promise. The cash is always the most active account in these examples. So let's do accounts receivable. It's the next account on our post-closing balance. So we have an account receivable account. It too is an asset account, which of course means that the debits are going to be increases to the account. The credits will be decreases. Debits are always on the left. Credits are always on the right. That will never change. It's just whether the credits are the one that increase or decrease that changes. So our accounts receivable is an asset account. It had a balance of 67,000. So that's our starting. Always question, do I have a starting balance? In this case, yeah, I do. I have 67,000. So let's look for the accounts receivable transactions now. There won't be as many. We got a credit to 47,000 to that account receivable. Need to put that guy in. The credit goes into the right side. Oop, then we turn around and have a $40,000 debit to accounts receivable. That on the left side. Accounts payable, looking for the next accounts receivable. Oh, here's one, 11,000 credit to accounts receivable. We've included that. Looking for the next accounts receivable, none there. But finally, a $30,000 credit here that I need to include. Put that down on the right. And that's all the accounts receivable. So again, I'm going to reconcile because I've included everything now from this period into my accounts receivable. Check the key. We do have everything included. And when I take 67,000, subtract 47, add 40, subtract 11, and subtract 30, I am left with $19,000 of receivables. Again, this is my unadjusted trial balance that is established after I have reconciled all of the things that have happened during the period in my ledger in step two. I want to look at one more, at least, maybe two actually, as I'm looking at these accounts and which ones are kind of weird. One of them that is a little strange is the very next one that pops up uh, on our post-closing trial balance. It's the allowance for credit losses, and it starts at a credit balance of 3350. Now, remember, this is a contra account. You might have heard allowance for doubtful accounts or allowance for uncollectible accounts. Credit losses is staying in line with new FASB that changed some of the procedures for accounts receivable. So now a lot of companies are calling it allowance for credit losses instead of the other names, but they all mean the same thing. It started at a credit balance of 3,350. Now, we did not change this account more than once. If we look through all of our work, we will not see it up until the point that we wrote off some of these accounts, 11,000 of them. So we have an $11,000 debit. Keep that in mind and just roll through the rest. But we didn't hit it again, right? So it only had one entry for 11,000. Now notice, like I mentioned, when we were working through it, I was like, we don't have enough to cover the 11,000. For this account, it's okay because this account is an estimate. It's a rolling estimate. And what this says is, if I just look at the starting point, ignore everything that came after, what this really says is, I have $67,000 of accounts receivable. That is what I'm pulling from the debit balance. I believe that of these $67,000 of accounts, $3,350 may be uncollectible. That's my guess. So this is just a reserve of things that might be uncollectible. Well, was our estimate correct? Ooh, clearly not. We estimated we might have. This was how many came up during the period. And so we have underestimated the amount of debt that was going to go bad. Right now, there is a $7,650 balance. Right? It wiped out the 3,350 and 7,650 is what's left. This is again an unadjusted balance moment for that account. What it essentially is telling me at this debit balance is we were $7,650 short on our estimate of bad debt expense. All right. Um, the only other things that might even, you know, cause you to question would be something like maybe the prepaid accounts. Uh, we didn't have a prepaid account as a beginning balance. So they're not here, right? But we made entries for them. So we have to have an account for them to live in. So, for example, prepaid rent did not exist when we opened the books on January 1st. But on that same day, January 1st, when we open the books, so the opening of the books happens at like, 12:01 a.m. Um, but then during the workday on January 1st, we prepaid some rent. So it started at no balance. And then I put in $18,000 with a debit in that first transaction. And that creates a debit balance of 18,000 for my unadjusted trial balance account for the 6 months of rent. Okay. All right. So I'm going to stop here for just a second. Well, not stop this, but I want to share my screen with the rest of them. Right. So this is all of the entries, all of the ledgers that would be posted and recorded. Okay. If you need more help with this, please do them on your paper. Understand how this is happening. Ooh, I forgot a line here. That's embarrassing. But basically, right, I'm just rolling through. I also have a very specific order. These are all assets, current assets first, the non-current assets, the patent, wages payable. Right? Notice that the prepaid rent and the prepaid insurance did not have beginning balances, but they were adjusted, or not adjusted, but they were had entries that we recorded for their unadjusted balances. The equipment, right? I sold some of it, sold the 50, have 650 remaining. The accumulated depreciation really should have a line after this 5,000 because 65,000 would be its unadjusted balance. Notice that I start all the liability accounts as credit balances because that's their normal balance. They are increased by credits, reduced by debits. So as the post-closing balance indicates, they have credit balances. That's where you start their balance. Everything else should read through. Notice that none of the expense or revenue accounts have beginning balances. It's because each of these accounts gets closed at the end of every prior period. So they open with no balances. These are what we call temporary accounts. And we'll revisit them in step 7. Right? The next piece then is our unadjusted trial balance. And what are we doing here? This is an uber important step when you're working through this a cycle on your own. It might not lack importance, but it might not seem as important right now because what I'm going to do is take all of the balances from all of my accounts and list them as debit or credit indicated here into my unadjusted balance. It's a check. It's a moment to see whether our debits equal our credits for all of the accounting that we've done, that we've added to this system since we began with the prior closing balance. So notice every trial balance, debits should equal credits, right? We started here, debits equal credits. If we made every journal entry and made sure our debits equal our credits, and then if we appropriately and completely brought all of those journal entries into our ledgers, then debits should continue equaling credits throughout the problem. So let's make that verification. Okay. I give you check figures for this unadjusted balance. All you need to do now is go through and take all the balances from what I just showed you. So let's go back to that ledger, right, where all the work has been done. You can see I'm going to write off to the side here. Um, I will be writing my amounts into my unadjusted balance as we go through them. So the cash is going to be at 122,750. That's its unadjusted balance. Debit. The accounts receivable at a $19,000 unadjusted balance. Debit. The allowance for credit losses. Notice it was a credit balance. It switched to a debit balance of 7,650. Inventory, a debit balance of 8,750. Prepaid insurance and prepaid rent, both debit balances, 18 and 12 respectively. Prepaid insurance is 12. Prepaid rent is 18. Land, 100,000. Nothing happened to it. It started at a $100,000 balance. We didn't buy or sell any land, so it stayed at a 100,000 balance. That equipment, we sold some, so it came down to 650 after that sale. Accumulated depreciation came down to 65 after that sale. The patent still at 75,000. Nothing happened to it during the period. My payables, the accounts payable down here, AP, started at 31, paid some off, bought some more inventory and credit, paid some off, ended up at 12,000. Wages payable started at 23, paid that was the amount that I owed them from their prior period work. I paid that off and some of their work during this month, the first half of this month. So I don't owe them anything as of the unadjusted balance date. So that is zero. My deferred revenue did not exist, but then I got a $24,000 advance payment, and that would be a credit balance of 24,000. Unadjusted balance. Nothing happened to my bonds. 300,000. My common stock came up to 11,000 after I issued some new stock. My additional paid in capital came up by 19,000 with that stock issue, 269. My retained earnings has not yet changed. It's still the beginning retained earnings, 312,650. Now, sales revenue did not exist on the post-closing balance, but we recorded some sales revenue. So that's $82,000, and that's a credit balance. Remember, revenues have credit balances, expenses have debit balances. So my cost of goods sold is 39,500. My wage expense for January at the unadjusted date is 25,000. And I had a gain on sale. Gains are like revenues, except outside the core operations of the business. So they have a credit balance. All right. took all the information from the ledger, put it into my single listing, right? We're organizing the information more. First, it was chronological, then we grouped it by account, and now we have each account balance listed. Unadjusted trial balance, right? Which means next we got to make some changes. Right? Why might we need to make changes? Is this a complete and accurate listing of where these accounts stand? Remember, I got some prepaid insurance that I took out at the first of the month for a year, but a month has passed. Is it still $12,000 of insurance prepaid that's remaining? No, we only have 11 months left. Same for the prepaid rent. This was covering 6 months, but now 1 month has passed. So there's not $18,000 of prepaid rent remaining anymore, right? Our equipment was used in the generation of revenue. We have to record some depreciation expense that will then increase accumulated depreciation. The patent has to have amortization expense applied to it because it too ostensibly helps my business generate income. So a lot of things have to now be adjusted for. And that's what sets up step four, which will be covered in a video that I'll put up Thursday. Thank you very much. And I hope this has made some sense out of the first three steps of the accounting cycle.